All right. Hello, everybody. It is good to be back down on the floor here, especially after a nice long weekend. I had a week of rest. I'm hoping everybody enjoyed Mike Shore and Charlie Moon and all of the info you got last week. But I am happy to be back. How's the sound coming through, everybody? What's up, Steve and John and everybody else in here? I see you guys. All right. Well, you know what? We got the markets up right now 48 points. S&Ps are at 60.81. Cash is 60.45. Volume is okay right now. What's really interesting, guys, because I was just over in the VIX pit, which is just, I'm pointing to my left here about 10 o'clock or so. This is the S&P 500 pit behind me. The VIX pit, I was just over there talking to one of my buddies, and even though VIX is pretty much, let's see, what is it right now? It traded up to 16 and a quarter. So it's down about 60 bips on the day here. There is a lot of upside February call buying. So, we'll have to see what comes out of that. We've seen this pattern before. And if you look at a chart in VIX, which we can do shortly here, we can see levels that have been massive support over the last 6 months, 9 months, 12 months. So that could be just people coming in here. But regardless, it is great to be down here. And while I was away last week, I actually got into a conversation with somebody that I met. We started talking about options and trading and, you know, the subject of whether trading, specifically options, is a zero sum game came up. So, you know what? I thought it was a great topic to talk about. And I polled people earlier today in some of our trading rooms, and it was about 50-50. People thinking that yes, it is a zero sum game, and no, it isn't a zero sum game. Now, I have my own thoughts based on being a trader, and I will tell you right now, before we go into the presentation here, I believe it is not a zero sum game. Okay. But that's for a variety of reasons. And we're going to go through a bunch of those. So, you know, what is a zero sum game? First of all, well, a zero sum game could be anything, whether it's trading, a card game, anything out there, a competition. Okay, when one side wins, the other side loses the same amount, and there is no net P&L. Okay. Um, and as you can see here, it's a metaphor that's often used in business to describe a battle over market share, right? And again, if I win, if I bet a dollar with someone, if I just make a dollar bet on something, okay, and there's a winner, that's a zero sum game. Okay, because I win the dollar, that person loses a dollar. Okay, that is a zero sum game. But is trading a zero sum game? Now, I've already given you my opinion of it, but before I go into this, let me see in the chat how many of you just say, yes, it is a zero sum game. No, it isn't. Okay. Let me see what the landscape is here before we go into this, because this is going to be a really interesting discussion. All right. I love seeing all these answers coming in here. Come on, let me get more. And while you're doing that, while you're answering that, you can also give us a smash. Okay, smash the like. Please. I don't know how much Charlie and Mike hounded on that last week, but smash that like. Okay, there's a depends. Bill, I like that answer. Okay, we're on both sides of the market. This is what makes a market, right? This is why there's trade here. This is we all have differing opinions, so that's great. Okay, well, let's dive into this a little bit here. Okay, so first, let's talk about stock trading. Okay, not options yet, but let's talk about stock trading.
Hey, Derek, I'll be
Okay. So there is a buyer and there's a seller on each side. Okay. And with each dollar that the stock moves, okay, one profits while the other one takes those losses. Okay. So we would all think that stock trading is not a zero sum game, because when you're buying or selling stocks, you're creating value. Okay. You can have unlimited gains. You can't have unlimited losses, just like selling a put, right? You can't have unlimited losses because just like an option can only go to zero if you're on the buy side, but a stock can only go to zero. Okay. They can only go to zero. Then, like this says here, what about if you own the stock goes down, but it pays a dividend, right? Do you count that in there? Okay. Now, if you really want to take it further, okay, if I'm buying stock, what am I actually doing? I'm providing capital to a company, right? So how is that capital being used? So stock trading is not, absolutely not a zero sum games. Okay? It is absolutely not a zero sum game. Okay? Now what about option trading? Okay? Here's the depends, I think, that Bill was maybe talking about. Okay. If you break it down, if you break option trading down, not by position, okay, but by contract, okay, by contract. Now, this is a very, very significant explanation here. Yes, it's a zero sum game. Okay. Every contract someone buys, there is a seller to it. And at expiration, and here's where this gray area depends comes in. At expiration, okay, what is every contract worth? It's either worth zero or it's worth its intrinsic value, right? So if I sell Mike over here a call option for $2 that expires out of the money, regardless, now keep in mind, this is regardless of what Mike may have been doing with that call option contract or what I may have been doing with that call option contract during the lifespan. Okay. The value of that option contract at expiration is zero. Okay. So by the contract, it is a zero sum. That individual contract made or lost $2.
Hello, are you 810 bid? Hello.
Okay.
Are you 810 bid?
Again, this is by contract, which is a vast. Bobby, what's up, man? Glad we got to connect yesterday, Bobby. This is a vast difference from contract to position or contract to actual trading. Okay, does everybody understand this so far? Does everybody understand this? Because there's going to be a lot of what ifs coming up here. Okay, and I want to see your commentary on it. And not that I'm going to have already covered what's coming up here, all of your commentary, but I bet I've got most of the points you're going to make.
I think I would pay 810 myself.
Okay, now what about over time? Okay, let's say that not just one contract. Let's say we have a vertical spread. Okay, that traded for 33 cents, dollar wide vertical spread, traded 33 cents. Look at the probabilities. Now, remember, okay, when we look at those deltas, what does delta measure again? Delta measures the change in the value of an option as the stock moves a dollar. It also measures the probability of that particular option expiring in the money. So if we had a $1 wide spread that traded for 33 cents, you would assume, okay, that 67% of the time, that thing is going to, the seller's going to make 33 cents. 33% of the time, the buyer is going to make 67 cents. That sure seems like a zero sum right there, doesn't it? I mean, the math is the math, right? The probabilities are the probabilities here. Can't dispute that. Okay. This certainly would seem like a zero sum game. Okay. Is everybody following before I go on to the next slide here? Something big's going on here. Oh, there's a lot of futures rolling. Okay. Everybody follow. Okay, great. Now, but in the real world, okay, remember what happens. Options don't trade at their intrinsic value, okay, until expiration. Or perhaps if an option is really, really deep in the money. Okay. But also, what you have to remember, okay, probabilities don't play out as expected. And that is because options trade off of implied volatility, not realized volatility. Options trade off of implied volatility. So, doing some back testing in this scenario, it is more likely that you're going to get a scenario that looks like this, that the 33-cent seller is not going to win 67% of the time. They're going to win 70% of the time. And the 33-cent buyer, okay, is not going to win as much as we thought. They're actually going to win less. They're not going to win that 67 cents 33% of the time. It only happens 30% of the time. So if you look at the true probabilities, the true odds, which is based on how implied volatility works versus actual realized volatility, now mathematically like this, you actually have a 3-cent difference. You have a 3-cent difference. Okay. Now, is this reality? This isn't real trading, right? We got to talk about what really happens when you put a position on. Okay. So think about what happens, all of the opportunities, all of the things that can happen when you buy or sell an option. Okay. Are you rolling that option? Because if you roll that option, now all of a sudden, maybe the initial buyer, okay, let's say you sold it, that initial buyer still has that initial contract. You don't have it anymore. Now you have a new position. Okay. And this is why you need to make the distinction between what happens to a contract versus what happens to your position in the actual aggregate P&L. Okay. What happens at expiration? What happens as implied volatility changes? And that's the big thing, right? Because we know at expiration again, okay, option zero or implied or intrinsic value. But what about in the time leading up to expiration? Like we just said, options trade based off of implied volatility. There is theta, there is premium. That premium fluctuates. Okay. And then I forget, Stephen, I think it was you in the room right before I came down to the floor. Maybe it was you or may have been Antoine. I can't exactly remember. Said, okay, what if you buy or sell an option, but you hedge that position with a different option or with stock? How do you factor that? Right? How do you factor that? So when you actually take all of that into consideration, option trading is not a zero sum game. By contract, it is, not by position. Okay. Also, think of this. When I make a trade, okay, when I make a trade, I don't know who I'm trading with, right? It goes into the stratosphere somewhere. It goes to OCC Options Clearing Corp and they match my trade up with someone. Okay. When I go to close out that trade, I'm not closing it out with that same person or that same entity. It's not like I made a dollar bet that, yesterday was Martin Luther King Day. And then we know it was, so I collected from the same person I made the bet with. Okay. So it is impossible. It is impossible to say that it is a zero sum game. Does this make sense to everybody?
Today, tomorrow.
And again, think of it this way. Okay. Steve, you sell an option for $1 that Bobby buys. Okay. Bobby doesn't like the trade or whatever, it goes against him. And Bobby rolls that option and pays 50 cents. So he sells that option to someone else, buys a different option. Meanwhile, let's say it's a call option and the stock keeps going up, 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 up. So, Steve, you own this call option. You keep making money. You keep making money. And now Bobby is already out of that original position, that original contract. Okay. Bobby's already out of that original contract. Someone else has it now, but we don't know what that other person is doing with it. Right. So there is a lot of what ifs when it comes to actual P&L, actual trading per contract, different situation. Okay. So kind of here's a little bit of a summary, if you will. Okay. Most people that are not traders, or most people that maybe are beginners, or most people just lay people that you may speak with if you went out on the street and took a poll, they would say that it is a zero sum game. It is not. Again, though, at the contract level, at the contract level, individual contracts, yes, but over time, that is not the case because implied volatility is greater than realized volatility. And because we don't know what those hedges are going to be. So let's get this up here right now, word of the day, and then I want to go into some stuff going on in the market.
And a half.
Okay. There we go. There we go. 0, 0, 0. Also, while we're doing this, what do you think of the Groucho Marx thing? I think it's getting a little old. I think when we first did the word of the day and I described the duck coming down and the Groucho Marx show, whatever the heck it was called, I think we got to change that up here. Still want to do the word of the day, but maybe got to have someone or something different from Groucho. I'm definitely open to suggestion on that. Definitely open to suggestion.
Today, tomorrow on the OF line, I'll be at 45.
Okay. So
across 300.
Does everybody also understand, going back to this right here, that implied volatility changes? Okay, again, I'm harping on this point because it's so important. At expiration, we know what every option is going to be worth, zero or its intrinsic value. But leading up to that, it is not constant. It is not constant. Oh, Paul, if I did that, I would choose Harpo in a heartbeat. Harpo is my favorite of all of them. Hopefully you guys all like the Marx Brothers. But this show was actually not a Marx Brother thing. It was the Groucho Marx show. Wonderful. All right, let's look at what is going on.
Today, tomorrow, half line. I'll be 45 bid out.
Yeah, there's a lot of rolls, happening here.
300 trade. I can buy more.
So let's look at this position, which we put on this morning, guys. Okay. And let's look at this in context of a zero sum game. Okay. Let's look at this in context of a zero sum game.
Steinmetz bid out on 100.
This is a diagonal call spread.
Tomorrow, OF roll 45 bid 100.
That's right. And Paul, at that time, $100, that was like, winning 10 grand or 50 grand. So take a look at this position right here. Okay. We bought a diagonal call spread. So we sold the 210 that expires this week. We bought the 205 that expires next week. Okay. Let's just play this out. Okay. Let's say the stock, goes to 208. Okay. Before expiration. And I'm sorry, it wasn't this week and next week. It's next week and the following week. Okay. 24th, 31st. Which, no, sorry, it is this week. I'm still getting my mind back into this. Okay. Let's say the stock goes to 208 after earnings today. Okay. That's going to be great for this position, right? 208 is going to be great for this position. What if I don't close the position? What if the person that sold it to me closes it? Okay. What if I don't close it? That person can make money. I can make money. That person can lose money. I can lose money. Or the amount they win and the amount I lose, or the amount they lose and the amount I win, don't have to be the same. Don't have to be the same, because the value of these options change up until expiration. Does this make sense to everyone? So again, at a contract level, yes, there's a buy and a sell, a P&L, not at a position or trading level. So all those people, and this is not a right or wrong, okay? Absolutely, this is not a right or wrong. But I want to make sure that all the people that said, yes, option trading is a zero-sum game, actually understand this. Do you actually understand that it really is not? Okay, think about how often we roll positions of our own and how that changes your P&L, changes a position.
Hey, how's that strip tied to 84 this time?
Okay, let me point out something to everyone here. Okay, here is VIX. So VIX January contract. Okay, the VIX January option contracts expire when, everybody? It's a question for everyone. Anybody?
I have a $50.
Anybody? Okay. Jake, Bobby say Friday, Saturday. Francisco says the 22nd. Gene, Friday. See, this is good that I brought this up, guys. This is good that I brought this up. VIX options, okay, expire tomorrow morning. The last time to trade a VIX option for that corresponding future. So this happens to be the January future. is today. At 3:15 today, okay, you can no longer trade VIX options that are based on the January future. And so the price that that option is worth is not based on this. Let's say that that is where VIX closes today. Okay. What is that? 15.15. Okay. Let's say that that is where VIX closes today. Okay. If you owned the 15 call, you would think, you would think that that option would be worth 15 cents, right? Wouldn't that make sense? Weren't we always taught that an option is either worth zero or its intrinsic value at expiration, right? Just like the 16 put, we would think would be worth 85 cents with VIX at 15.15. Okay. But that's not how it works. Okay. That's not how it works. Even though that's the last time to trade those options, the VIX settlement price, okay, the VIX settlement price, which is what all of the options are valued off of, is different from the closing price. So what happens is tomorrow morning, there will be a calculation based on what is happening with S&P options. And there will be what is called a print. Okay? A print. That print would be the settlement price. Again, that is based on what is happening to the volatility in S&P options. So even though VIX may close at 15.15 today, that print tomorrow could be 1480, could be 1517, could be 1540. Okay. The print is typically not enormously different than where VIX closes, unless something, really, really massive happens overnight. But that is how the VIX works. So if you own a 15 strike call, again, okay, let's say you end the day owning this 15 strike call that expires tomorrow morning. It is not necessarily based on that closing price. That thing could be worthless, even though right now with VIX 15.17, you would think it would be worth 17 cents. That thing could be worthless. It could be worth $1. You won't know until the morning. You won't know until the morning. Okay. So that is why you see the expiration here when I asked when do these VIX options expire. That's why you see January 22nd, tomorrow morning. Now, some platforms, and I don't know why they do this, some platforms out there might show January 21st as the expiration. That's because that is the last time you can trade those options. The actual expiration is the 22nd. Regardless if it says the 21st or the 22nd, it is the same pricing. I don't know why it's not uniform. It should be, but the actual expiration is the 22nd. Okay, guys, let's hit the wheel. Let's hit the wheel here and see what we have today. Where is my wheel here? There it is. Okay, wheel of names. There we go. And just so everybody knows also, we have got some brand new swag that is in production. Brand new swag just for Market Minds that have the Market Minds logo and everything on it. So that'll be out soon. Okay, let's give it a whirl here, guys. The wheel is spinning, and today's winner is Elias or Maria. Oh, I think you won a few weeks ago, if I'm not mistaken, and that's okay. That's okay. Are you here? Are you still in the house? I hope you're with us. Otherwise, we're going to have to spin again. Susan, are you in the house? People are probably wondering why I'm saying Susan.
Wendy, are you nice?
All right, she's here. Nice job. Nice job. All right, everybody. Thank you so much for tuning in. I am glad to be back with everybody.
Where's Derek?
Hope you liked today's content, and we will see you tomorrow.